pounding a little bit here as reports circulate that the Trump administration could reduce the scope of tariffs to be placed on many countries on April the 2nd. Cars, microchips, we see pharmaceuticals, all could be left out of those levies entirely, or at least receive a lightened load. The US Federal Reserve, we saw, however, saying last week that although growth remains solid, the economic outlook still remains uncertain. The impact of Trump's policies continue to have a bit of a hold on markets. So as we brace for more change, what ultimately does it mean for investors? Joining us here today to unpack the macro themes on his radar and what it might mean for you is Fidelity Director of Global Macro, Jurrien Timmer. And we should add a very happy 30th anniversary. Jurrien is celebrating 30 years with Fidelity Investments, an incredible accomplishment. A huge congratulations to you, Jurrien. Hello.
Good morning, Pamela. Thank you very much. Yeah, it's quite a milestone. I didn't really appreciate the significance, looking ahead towards the anniversary until I actually hit it. And it's like, wow, you know, comparing that to the early feelings of imposter syndrome when I started, it's like, okay, I guess I've earned my keep around here. So.
I want to ask you a little bit about this. I'll inform everyone, please to send questions in or even congratulatory notes in, but also note that this discussion is presented obviously in English, but it also features a live French audio interpretation as an option for you if you want to go ahead and use that. You mentioned when you first walked in, so 30 years ago. Tell us how that looked and what you were doing actually at the beginning.
Yeah, so it's I remember it very clearly. So I was I was in New York City on Wall Street for my first 10 years out of college. And the company I was working for was a Dutch bank. It kind of got a little dysfunctional, so I felt I needed to reinvent myself. And a friend of mine who was a technical analyst in the bond market at the time was approached by Fidelity to hire him as a technical analyst in the fixed income group. And he was at JP Morgan, so he wasn't interested, but he said, go call Jurrien. And they did. And, I mean, I was like, it was 30 years ago. It was like 1994. And, I interviewed, like as typically happens, you go through like 3 or 4 rounds. And it was like, okay, this is an impressive place. You learn about Fidelity, its commitment to excellence. And this was a position in the chart room, but on the fixed income side. So really kind of like a very narrow needle to thread, right? You're a chartist in fixed income. And my last interview was with Ned Johnson, because if you were going to work in his chart room, he needed to have the final say. And so I remember, as clear as yesterday, sitting in his office at 82 Devonshire, and we chatted for an hour about the markets. That's all we talked about, and the rest, as they say, was history. But when I actually joined, so this was like 2 months later, in March of '95, we had just had the tequila crisis in Mexico, the junk bond cycle. We had the Greenspan tightening cycle with rates, going way up. And the new mandate out of fixed income was we're not making any duration bets anymore. We're just going to do, bond by bond, bond picking based on the credit worthiness. And so if you're a chartist doing macro, it's like, okay, now what do I do? You're already kind of in this very specific field anyway. And then on top of that, the fixed income group was about to move to Merrimack, New Hampshire, which is a fine place, but I just come from New York, going to Boston. I didn't really feel like then shipping off to Merrimack. So I reinvented myself again after just a few months there. And I went over across the street to One Federal, which is where where the equities were. And I started doing multi-asset, but just those early days, knocking on doors of portfolio managers, pitching ideas, right? So it was intimidating. I mean, not that people that I work with are intimidating, but I had like major imposter syndrome. I'm like, I don't know what the hell I'm doing. I'm just drawing lines on charts, and so, but you learn, and a few key people coached me, it's the value of mentorship, right? And I just evolved, and I started weaving in the fundamentals, right? You see from all my charts, it's kind of a cross-disciplinary approach, because I figured, I better speak their language, right? They're mostly interested in the fundamentals, and I'm just here drawing lines on charts. So I reinvented myself and just adjusted my product based on the market while still maintaining the integrity of my product. And that's proven to be, a successful strategy. And here we are 30 years later.
Amazing. I mean, it's really incredible. And as you say, the reinvention process is, I guess, something we all have to go through. But I mean, we look at your career now, and it looks a bit exponential rather than incremental, to be honest. So look where you've come. How did you get there? Reinvention was obviously part of the beginning of some of your own cycle
Yeah.
in your job, but
I'm a firm believer. So when I was younger, right? So I had a stint running assets, of course, including for Canada. So I did that for 7 years, and I was okay at it. But it was during the financial crisis. It was hard to gain traction, and it was also a kind of market where you could not be a little bit right or a little bit wrong. You were either on one side or the other, and so it was kind of a roller coaster. And we went through this whole skill and efficiency effort where, the business gets commodified. So you have to have a lot of skill. You don't have to be like Will Danoff skill, but you have to have at least a couple of billion under your belt. And we were like at 500 million or so. So again, decided to focus, or the company decided, like, you can make more impact doing these kinds of things, yet like you reach more people than running a smallish fund, right? And it's hard to do two together because the business, at least in the States, is so regulated. And so, but I've learned that, you have a lot of people in my business, and you see them on social media or on TV, and they want to get those big calls, right? And have it with a lot of pizzazz. And to me, like, I'm like so over that, right? I might get criticized for not making the big bold calls, but I've learned the lesson or the value of compounding, right? That's a feature, of course, of investing, but it's also a feature in relationships and work and careers, and doing, and Fidelity has this philosophy, this Japanese philosophy of Kaizen, right? Where you make incremental, ongoing, relatively modest improvement, but you do it over a long time, and it compounds. And that's, for me, the lesson is, I've done this 30 years, um, and just doing the little things right, but doing it in a very consistent way. I've been writing the war now for like probably close to 20 years. And if I can help make investors feel more confident about where they are in the markets, and I can do that consistently over many years, to me, that is more important than having these big calls, right? And so that, to me, is the main thing that I take away, that I would want to impart on maybe younger people. Like, you don't have to shoot the lights out. Just do something good and do it consistently.
there's some real humility in what you're talking about, and that is never a bad thing. We're so grateful that you bring us some of these thoughts, and the iterative process is part of our week as well. So congratulations on your
Thank
very
you.
big anniversary and huge accomplishment as a career so far.
And I'm not going anywhere.
I know you're not going anywhere, so I got some questions for you here. um, let's talk a little bit about the correction that we're in right now. You've often talked about the anatomy of corrections. Well, we're in one right now.
Yeah.
It's not even sort of gazing at it of what could happen. What are we in right now?
Yeah. So let's go to slide one. So we've had a 10% correction. Whether it's over or not, obviously, we don't know in real time. The market's bouncing nicely today, but one thing we've learned from 2025 so far is that the markets are full of what we call tape bombs, right? So the tape is the ticker tape, as we used to refer to it in the stock market, and a tape bomb is like a news event that just, like, oh my God, So tape bombs are par for the course these days. But here you see the S&P fell 10%, the Mag 7 fell 22%, and the Russell 2000 fell 20%. So that's a very odd barbell of outcomes, where small caps and mega caps are down a lot, and the general market is down only modestly. And so we know the math, right? Historically, market goes up 60, 70% of the time, which means that it goes down 30 to 40% of the time. for all of us investors and everyone watching, the trick is not to participate in the 70%, but to survive the 30%, right? Because we know that equities deliver healthy returns over the long term, but the price of admission is navigating the percentage of time that it doesn't go. And we want to be ruthlessly analytical about that and play the odds and do the homework and not get emotional. And of course, the folks who are on this webinar will get the calls from their clients, and so we know how that works. So whether 10% is all we're going to get or not is unknowable, but we can look at market history and try to learn a few things. So if we go to slide 4, for instance, this is the S&P 500 equal weighted index, a weekly chart. Like I said, I used to be exclusively a technical analyst, so I still look at that. This is actually a pretty good looking chart, right? So you see a 3-wave decline. That's Elliott wave theory, ABC, wave C equals wave A. The market stopped right on former resistance, now support, which is that arrow there. And at the bottom, you see that breadth, the percentage of stocks above their 50-day moving average, made a higher low. So we call that a bullish divergence. So this is a pretty good looking chart. This is a chart that would tell me this is just a bump in the road. It's a 10% decline, nothing to get worried about. But if we look at the next slide, which is the Mag 7, and it's only 7 stocks, I know, but it's 7 stocks that comprise a third of the market, so we cannot ignore them. Here, this last decline looks more like a third wave. Not to get too technical here, but it looks more impulsive than just this little correction. And this suggests to me that maybe we're going to have a couple of months, not of declines necessarily, but of churn, right? And that brings me to this risk of concentration in the market, right? So we know, of course, that while the US is in a correction, or at least it was, the rest of the world has actually done quite well. And actually, if we pull up slide 13, I'll show you MSCI China. That's a pretty good looking chart. When China was left for dead, it was deemed uninvestable. And all of a sudden, China and Europe are the ones that are creating a fiscal impulse, if you will. And so we're seeing some nice action there. So the good news is for diversified investors that, unlike 2022, where there was no place to hide, in this cycle, if this ends up becoming a more severe correction, there are many places to hide. Bonds have done reasonably well. Europe, EM, or at least China in EM. So it's a more mixed picture. And if we go back to slide 6, I show you the MSCI All Country World ex-US. So this is the rest of the world, not the US. It hasn't made a new high in a number of years, but it's close to that, right? So as the US is coming down, at least the Mag 7 is, the rest of the world is holding up. So there are places to hide. And then it's a question of if this rotation to the rest of the world continues, which I think it very well might, does that happen in an up market or a down market? So do you get the alpha and the beta, or you just get the alpha and not the beta?
Do you
And
mean
that I think
US? Sorry to interrupt, but do you mean an up market or a down market for the US, or actually a global discussion?
basically globally. But especially the US, but globally. And so that gets you to the really difficult question of if the Mag 7 rotation is the start of something bigger, like that big rotation we've always talked about, can the market actually go up? And what we're seeing so far is the answer is yes and no. The US market can't go up if the Mag 7 are going down. We see that, right? The market goes down less than the Mag 7 because other things are working. But ex-US, as you see in the chart, I think at best it can go probably sideways. So if this is a period of course correction where the rotation goes from US exceptionalism to the rest of the world for a while, for totally unintended consequences, right? This was not on Donald Trump's bingo card, right? He wanted to make America great, but maybe it created a catalyst for the rest of the world to start taking care of themselves, which of course comes at a cost. You have to spend money that nobody has, and so you have a fiscal impulse there. But in that environment, I think there's going to be not very much beta to be had, but it's going to be alpha, which is fine. Like you just position yourself along your benchmark, and you just do the second order rotation. But those are some of like the thorny questions that don't have a clear answer, just because we've had so few instances historically where you have had such a concentration.
So grateful to have your expertise here. Do you think that with China and with sort of Europe, particularly, was China, because Europe traditionally has been controversially a value trap, right? And so it's changed because of policy, if you agree with that. And China has changed because of what? It just stopped being a value trap? What happened there?
Yeah, so China was trading at a 9 PE, and as we've said many times, valuation alone is not going to do it. You need a catalyst in the form of fundamentals. And just to throw, I'll give you slide 11 here. The fundamentals have to somehow relate to earnings, right? And so in this chart, the pink squiggles are the MSCI EFA earnings estimates, so non-US developed, and the blue lines are the S&P. And you have to kind of squint to see the change, but you can clearly see there's some momentum on earnings revision for non-US developed markets. And it's not coming necessarily at the expense of the US, but the US is just kind of doing what it normally does. It's in a mature bull market cycle, a more mature earnings cycle. And so it has to come through via earnings. And for Europe, yes, it has been historically a value-oriented market. It's more financials. It's not as growthy, and I don't think that's necessarily going to change. But with Germany having an election towards the center-right coalition, and now essentially putting aside their debt to GDP limits, they're going to have a fiscal impulse. It might be more modest than what we saw, for instance, during COVID, but it's going to matter. It's going to be defense, infrastructure. They need to sort of grow up and stand on their own feet and not rely on this global policeman, that's always kept the world safe. I mean, it's nice that it always worked out that way, but I think Germany now has to say, okay, we got to do this. And China, it's kind of the same thing, right? I mean, China certainly has growthy companies, but it also has a lot of SOEs, state-owned enterprises, and the valuation extreme did get pretty high, and now China needs to grow. China, the main issue with China is that the Chinese people, the consumers, are not spending their money. So the savings rate is sky high. And so the Chinese government needs to do something to unlock that. So they don't really have to spend necessarily. They just have to create a more appealing backdrop because there's plenty of money. And bond yields are like 1% there now. So there's not a lot of places to put that money. So they just need to sort of unleash the animal spirits if they can do that.
So just to insert the question of tariffs, which we haven't really discussed yet. I mean, China pivoted away in Trump 1.0 because it had to, because of tariffs. I mean, more tariffs are going on. It's still part of the tariff story, but arguably they're less vulnerable to tariffs than they were, 4 or 5 years ago, because they did some of that pivot. And as you say, the main problem is sort of the domestic consumer, buying domestically. So it's just so interesting. Many of the things you've been pointing out over the last little bit actually have nothing to do with the Trump administration policy, really, or to the tariff story, really. They're kind of fundamental country or global stories that are coming into this.
Absolutely. I think China's wounds were mostly self-inflicted, right? I mean, they had obviously a massive property bubble because again, if you have some money and you're in China and you have capital controls, you can't get your money out. Although some people found their way buying houses in Canada, of course,
Yes,
over
they
the
did.
years. But if you don't have a place to put it, right, and bonds are have low rates, the deposit rates are very low, you end up either speculating in the stock market, which of course people have done over the years, or to buy property. And property was kind of that free ticket, right? And you got a bubble, misallocation of capital, and then you got these a few years ago these very obviously the COVID response was extremely severe, right? People being locked up in their own places, and then you had these very autocratic. Uh, not, market unfriendly policy moves, right, where they really punished companies. And I think they're walking back a little bit from that. They realize that they need to compete and they need to unleash those animal spirits to the degree that they can. And I think that's what we're seeing. And when you amplify that with like the US was trading before this correction at 22 times earnings, MSCI China at 9 times, right? I mean, that is a massive, massive difference. So again, you need a catalyst that is more fundamentally inclined. But once you get that, that valuation difference can really amplify. So I think that's what we're seeing. And whether it's a trade or something that really has legs, I think we don't really know. But the PE has already gone from 9 to 14, so we already had a 5 PE rally in China. But to your question, I think the bigger existential question about tariffs that I think the market is starting to really grapple with is whether they are a means to an end or the end themselves, right? And I think in November when we had the election, the market repriced itself in a very constructive way. It said, okay, we're going to have deregulations, we're going to have extensions of tax cuts, and the animal spirits are back, and we're going to sort of get out of this stagnating economy. And yeah, there's the tariff stuff, but these are just threats. It's art of the deal. Like I think that's the market kind of brushed that aside back in November and December. And now I think it is realizing that maybe they are the end and not the means to an end, meaning that if the ultimate goal is not to, obviously the goal is to get better trade terms, but if it's beyond that also to really get the supply chains back in the US to bring those high-paying manufacturing jobs back, then the administration cannot be seen as bluffing. It has to actually do this. And getting manufacturing jobs back is not something that you do in a couple of weeks. That's going to take time. We don't even have the engineers like to do that, right? I mean, China has been growing engineers like weeds, and we're not doing. We've been growing MBAs instead, and so that's going to take time. It could be inflationary, it could be stagflationary. And when you add that to all the government spending cuts, at least that appear to be underway via Doge, all of a sudden the market has to come to grips with the possibility that we actually could have a recession. And Trump and Bessent are already saying, like, well, we're okay with that. That's the price to be paid for that. But that's a dangerous game, right? Once you create a recession, how do you know that you can get out of it when you need to, right? I mean, government spending is already 6% of GDP, so it's not like you can just spend more. And the austerity is very much part of the landscape right now. And the Fed is at 4 3/8. It has some room to cut for sure, but inflation is still above target. So I don't know how many arrows the government has in its quiver to stop a recession in its track if it ends up getting a life of its own. And so I think those are some of the questions that the market is kind of struggling with here.
Fascinating. And as you say, that some of that is being priced in, sort of some people are pricing on standing on the edge of a recession. That doesn't mean all pricing is that way. But enter the Fed, and we might even ask you globally about central banks. They are all a little bit in a version of stagflation watch of prices potentially going higher, inflation because of tariffs, because of other things too. And stagnating growth, the sort of growth shock situation. So enter the Fed, but maybe all central banks, if you don't mind your comments on the non-move decision.
Yeah, so let's go to slide 16. So obviously the Fed met last week. It did nothing, which is exactly what it should have done or not done. The dots changed only slightly, so these are the updated dots. And so the market, the dotted line is the forward curve, and the dots for 25 and for 26, they're right in line. So the markets and the Fed are all in agreement that there's a couple more rate cuts, but there's no rush because the Fed, it's much better to wait if there's no clear and present danger for the economy, which so far there doesn't seem to be. So it's better to wait than to cut too fast and then have to take them back later. And so I think the market is okay. And again, the long end matters more than the short end, right? So the 10-year yield is pretty stable. If we go to slide 17, it's at around 4.3, significantly below the 4.7 that it was a few months ago. And so that's the rate that matters, right? The Fed funds rate, nobody really uses, right? And people are not exposed to short rates the way they used to be. So there's not as many variable rate mortgages and things like that. So the long end is what matters. And the long end is kind of right in the zone of fair value right now, let's say 4.5. And then from there, it's really a question of, if you believe the term premium is going to rise because we have to borrow so much money in this country, then yields will probably eventually go to 5 or above, and that's going to have an impact on obviously the bond market, but also on the stock market. But if the danger is more to a slowing economy and inflation, it has improved, or the rate of inflation, it's about still in the 2.5 to 3% range, which is obviously better than 9%, but not as good as 2%. So if right now the worries are more about economic growth, then we could end up staying in this 4 to 4.5 range, and that I think is a pretty good outcome. That allows mortgage rates to settle down a little bit, and if companies have their debt coming up for refinancing, they'll have a slightly more friendly place to do it. But of course, this is a global question. You asked about other central banks, and of course, what we're seeing in Germany was a very rapid repricing in the term premium there. And so it shows you that when you get a fiscal impulse, whether it was us during COVID or now Germany, there is a price to be paid for it somewhere. It could either be in the currency or in the bond market. And Japan, of course, saw that it was able to repress yields, but it had to pay the price through a weaker yen to do it. So no matter what, something has to give, and it's just a question of, are you willing to give that? Are the benefits that you get worth the price you pay? And I think in Germany's case, they are concluding that it is, because the European Central Bank can always do something to make yields go down. Yeah.
It is just fascinating watching the world right now. Very exciting and sort of on the edge of your seat kind of time to exist. We have just a couple of minutes left, but could I just ask you, Bitcoin versus gold right now? You mentioned, I think, somewhere that it's more about sort of the value of having Bitcoin. And I wonder if you can just extend that thought with just
Yeah.
seconds to go.
Of course. So a quick update on Bitcoin. So slide 19 just shows, obviously we had a major bottom at 15,000. Was that last year, 2 years ago? We've rallied. We're kind of following the analog of previous cycles. You can see a very clear 4-year cycle, obviously related to the halvening cycle. And if we go to slide 20, the various demand models that I've explored and shared with you over the years, they're still in place. The orange line, which is the size of the network for Bitcoin, has lagged, but I think that can be mostly explained by the fact that we have all these ETFs or ETPs here that only need a few wallets. And also you have companies like MicroStrategy that buy massive amounts of Bitcoin and do it with one address. And so the address count is losing its relevance, which is unfortunate because it makes it harder to gauge real time how fast the network is growing. But when we look at, so I view gold and Bitcoin as different players on the same team. So slide 21. And then, I think Bitcoin is aspirational money, hard money. And of course, money, paper money is soft money, right? So it's always a battle between hard and soft money. And if the money supply grows too fast, then hard assets, kind of catch up. And you see that here, right? So that purple line is the market value of gold and more recently gold plus Bitcoin. And the combined market value is now 20 trillion. So gold is 18, Bitcoin is 2. And the money supply is at 21 trillion. So imagine that. So hard money has taken market share from soft money, which it does when soft money is growing too fast, right? I mean, that is essentially the value proposition. And so when you extrapolate that and you go to the next slide, and again, this is pure speculation on my part. But if you take the value of above ground gold, so the gold that has been mined, and you assume an 8% growth rate, which is historically what gold has grown at, you get the black line there. And then the orange line is the market value of Bitcoin, which again is approaching close to 2 trillion. And then I've got these demand models, right? The purple line and the pink line. And so a lot of Bitcoiners, it's kind of pie in the sky stuff like, gold's going to get demonetized, Bitcoin is going to take all the market share. I don't really see that happening, but based on these curves, it could happen in 10 or 20 years, but that's assuming that gold only grows at 8%. And if Bitcoin goes to where the people, a lot of the bulls think it will, including myself, by definition, it would argue that gold will be growing at more than 8%. So I think gold will remain the quieter, older sibling of Bitcoin as it has been, and I think that will continue.
Fantastic. Thank you so much. It was actually a particularly special conversation with you, Jurrien Timmer, and for kicking off our week. We'll see you soon.
Great. Thank you very much.